Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
Harley, it sounds like you did everything right. You found good properties, you rented them out, but now you've got a problem. It's a good problem, but it's still a problem. What's going on?
Many of these properties appreciate because we've had great appreciation in the last several years to the point that the rents in the market do not proportionally keep up with the amount of equity that you've grown. And most banks want you to have some skin in the game. So you can keep cashing out refi, but at a certain point, you still are going to have 20, 25% of the value of the property in equity holding up in the real estate. And if you are looking at your return on equity, oftentimes that may not be a very good number. Of course, you've got infinite returns on your original investment. You've done the cash out refi, got your capital out, but you still have a lot of equity there, which is part of your net worth that isn't working very hard for you. And so we've had great success then selling those properties, rolling them into larger or more profitable properties using 1031 exchanges, or just taking advantage of lots of tax write-offs when you buy a new property and renovate it.
If you're looking for the secret on how to build wealth with rental properties, this is one of them right here. Harley is going to show us how he took that equity he made on the first set of properties and how he's trading up to bigger and better properties, and he's increasing his cash flow and building his portfolio. Really great story. Joining us on the podcast today from Chattanooga, Tennessee is Harley Green. We'll take a quick break to thank our sponsors. We'll come right back and we'll talk to Harley. It's a lot of work to find a really good rental property. And when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender, and her specialty is helping investors finance rental properties. She has a ton of loan programs, and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com, NMLS 42056.
Rental Income Podcast.
This is something that I think about all the time. I've got so many properties where they've gone way up in value, but the rents haven't kept up. You know, a very similar situation to what you were in. So, like, when would it make sense, you think, for me to maybe trade up to a better property?
So it's going to really depend on every person's individual financial goals and things like that. One way we look at it, since we do kind of have a relatively large data set of properties, 13 plus homes with different numbers and different types, so we can kind of take a look at a relatively big picture and say, comparatively, right, what is an individual home doing with its ROI and ROE versus our other ones? And so if it's like out of line compared to everything else, so for example, I'm looking at my spreadsheet here, it looks like we've averaged about a 38% return on like real estate on an annual basis in general between cash flow and appreciation. And so if I see a property in there and it's one of these condos that's down in that 15% range, that's half of what the average is for our investments. Right. And so I know that just based on what we've been doing before, I can do better than that.
Yeah. Okay. So you're watching not just the cash flow, you're watching the value of the property and looking at the total return.
We're looking at the value of the property. We're looking at the balance of the mortgage because that's going down every month. Tenants paying for that. And so that makes the equity go up, which if your rent's the same, that makes your return go down.
Mm-hmm. Yep, that makes sense to me. All right, well, let's get into your story and figure out what you've done. Let's start at the beginning. How did you first get started buying rentals?
Yeah, so we got started in the Northern Virginia market, which is amazing for appreciation. It's not that amazing for cash flow. And we were young and we just knew, hey, we want to diversify our portfolio. Let's get some real estate going. And, we did very well with like rent ready on MLS condos, and they cash flowed a little bit and we enjoyed great increase in our net worth from appreciation. However, when it's appreciation, you can't really use it for much. Like I can't go buy a new car with appreciation.
Right.
We're in the process of liquidating our final investments back in Northern Virginia. Right now, we just listed our final condo for sale. And so we're heavily invested in the Southeast right now. We've got a lot of single family homes in the Chattanooga, Tennessee market, where we've enjoyed great appreciation and great rent growth over the last couple of years. And we also have 3 beach houses in the Myrtle Beach area of South Carolina.
Wow. Okay. So you've got what sounds like a pretty diverse portfolio. So when you started, so your first properties were in Virginia, and what were you buying back then? And first of all, I guess, where was this? Like, when was this? When did you start investing in rentals?
So we kind of fell into real estate investing with what's now called house hacking. We didn't know it was house hacking at the time. We kind of bought our dream home, if you will, in Northern Virginia in Loudoun County, and had 11 acres, a large home on it. And we found ourselves, after a few months of living there, like, we never go in the basement. And it's a finished basement, 1,000 square feet, bedroom and a bathroom. And so we started renting that out. That got our feet wet with how to do tenant screening, how to do leases, collect rent. Started realizing some of the many benefits of the tax benefits, where we can start writing off a portion of our utility bills and expenses related to the home. And so in 2016, it got to the point where we're like, hey, this basement rental thing's been going well for a couple of years. Why don't we get a separate standalone investment property? So we made our first standalone investment purchase in May of 2016. We had been looking for a few months prior to that, and we found like a short sale deal. So this is back in 2016. The market was just starting to really kind of pick up again, recovering from 2008. And so we were still seeing situations where there were foreclosures happening, and we bought a short sale where the people who had been selling it to us, they had to walk away with nothing from that. It was really sad.
Yeah, totally. And so what did you pay for that first property?
Yeah, so that first property, it was originally listed for, I think, 185. We offered them 180. They accepted, and then the appraisal came back at 170, and the bank was like, okay, well, we'll take 170.
Okay. Yeah.
That's great for us.
Great.
And, we were just basically trying to diversify. So, we had kind of grown up knowing, hey, you set aside some money, you put it in like index funds. And so we were basically kind of pulling money from what we had, a large stock portfolio, and transitioning that to real estate. So we just did a conventional investor mortgage, 25% down, bought this on MLS. And the nice thing was the rental demand was still very high at the time. And we were able to market it on Craigslist at the time, if you can believe that. That was where we got all of our rentals tenants at the time. And we had a signed lease on the day that we closed. And so those people moved in the same day that we closed. We basically got the keys from the title company and just handed them over to tenants. It was rent ready, and we cash flowed on day one.
So perfect. So no work to do. I mean, you literally found that property. It was move-in ready. You put it on the market. You found a tenant. They moved right in. Like, you didn't have to do any work at all to that property.
No, I downloaded pictures from MLS and pasted them up on Craigslist. That was it.
I love it. So how many condos did you buy in Virginia?
Yeah, so we ended up with 4 condos in Virginia by the time we moved out of the state in 2020. We got that first one in 2016, and then we got another one early 2017. I think we got another one late 2017. 2019, we did kind of our first true like BRRRR with the renovation. We ended up doing kind of a BRRRR strategy on these, with just the fact that COVID had a situation with interest rates being historic lows and property values being historic highs. So we took advantage of that, and we can talk about that as well. But we ended up with 4 condos, all being purchased in that 170 to, I think the most we spent was maybe 205. And they were like 2-bedroom, 3-bedroom condos.
And you've been selling those properties off now. So what have you done with that equity that you created by selling those properties?
So in 2019, we took a trip down to Myrtle Beach. And my wife being a real estate agent and us both being real estate investors, of course, we spend the rainy days going on Zillow and looking at the local real estate market, and saw some listings for sale that looked pretty promising, and plugged them in and looked them up on Airbnb. And we're like, hey, these numbers look kind of interesting. Maybe we could get a house and then we could vacation in it here with our family. We had 3 children. We know we like to vacation a lot and travel. And why not take advantage of having a tax write-off for that? So we bought our first beach house, and it's a couple blocks back, little 2-bedroom, 2-bath condo. We used a second home, vacation home mortgage for that. So we were able to just put 20% down instead of 25%. And that worked well. There's kind of trial by fire, learning how to do a short-term rental, but we figured it out. And it got to the point in 2021 where we realized these condos in Virginia had so much equity. They'd appreciated so much. And even after doing that cash out refi in 2020 with COVID, getting all of our capital back out, there was still a lot of capital in the equity. and the rents were not keeping up with the amount of equity we had. So the return on equity was relatively low compared to what we were getting on our investment on that first beach house. And so we were like, well, you know what? Maybe we can get another beach house. Like, these things are doing really well. We've got a great cleaner. We got the handyman. We've got the systems in place. Let's double down on that. So in 2021, we listed it for sale, and we sold that original first investment property condo that we had bought for $170 for $263. So it almost gone up $100,000 just in appreciation, and it had cash flowed every single month since we owned it. Even though we'd done minor upgrades, I think maybe we had to put a new HVAC and one round of painting between tenants, but that was all covered by the proceeds from the rental income.
Wow. Okay, so all the condos that you bought, did they all appreciate around 100,000?
Some even more.
Okay.
Yeah. So we actually just got a condo under contract, and it set a record. It hasn't closed yet, so I'm not going to say too many details about it. But it's under contract for a record amount for that condo facility. Awesome. For that size of a unit. They continue to appreciate. And we just listed another one today that will be selling that's a little bit larger, and anticipate another record-setting sale, even though there's nothing fancy about them. Like we did investor-grade upgrades to these. These are not luxury condo units. It's just the demand is so high.
Now, when you were buying these properties and deciding to buy these properties, were you just looking at the cash flow, that we're buying these for cash flow, or in the back of your head, did you have a feeling they were going to appreciate too?
That's a great question. And so for us, we were not cash flow junkies at the time. We both, my wife and I both had great jobs. I was a software architect, so I had a great salary and I loved my job. And I really didn't think I'd ever retire from it until health or something forced me to, because it was so easy to do and so lucrative. And so we were really looking for diversification and mostly focused on the appreciation potential. Of course, we didn't want to have an expense to own an asset, but that was not a big factor for us. And so and there was a lot of fortune and luck, I will say, in just the fact that we lived in an area that had really good appreciation potential. So we kind of fell into that naturally.
Yeah. And, it's really pretty awesome. I mean, you hit it perfectly, buying in 2016, and then, the market since then has done really well. But there's no way you could have known that in 2016 that you would make as much money as you did. I mean, I gotta hand it to you for taking the risk, or taking the chance that these things could have taken 20 years to appreciate that much. But in 5-6 years, you made over $400,000.
Yeah, and that's a really good point. When we were buying these, we had that 30-year time horizon. I remember looking at our spreadsheets for the analysis on these, and I'm an engineer. My wife is a high school math teacher and then a real estate agent. We are not big risk takers. We calculate everything. And so we actually made decisions that kind of hurt our returns. We paid for points when we closed on those cash out refis to get a lower interest rate, because I was like, hey, this is a historic low interest rate. We're going to hold these things forever. Let's pay it down and increase the overall cash flow for us, because in 7 years it'll pay for itself. Well, we sold it a year later, right? Because the power of real estate appreciation, it was not something we could have anticipated. It was just life-changing. And it got to the point where last year I was able to retire from that lucrative software architecture job because I didn't need it anymore because of cash flow from real estate.
Yeah, that's so awesome. Now, paying points, I think that's an interesting thing that, for anyone that doesn't know what that means, when you get a mortgage, you can pay extra money up front to get a lower interest rate. And I've done that several times where, I've done exactly what you did, where I paid points to get a better rate. And then I've always ended up refining or selling that property. So after what you've been through, do you think it ever makes sense to pay points?
I will say no. And here's why. If you just look statistically, even if you're a residential home buyer for your primary residence, most people only live in the same place for 7 years. And so it's very rare that the cost benefit of paying for those points pays off. The loan people are going to tell you, yeah, pay those points. You're going to live in this house forever. But the reality is just we don't do that. And then if you are a serious real estate investor, even if you're starting small like we did, just a simple condo, you keep rolling the proceeds and the profits back in and snowballing it. your life is going to dramatically change in a 5 to 6 year period in ways that you can't even imagine today.
It's so true. So true. Okay, so you took the money that you made from the condos, you moved that to buying 2 different beach houses. So did you have to put in any extra money, or did the down payment or did the profit from those condos pay for the beach houses?
Yeah. So if you consider the money that we had pulled from the cash out refis, we really didn't have to bring any personal money. It was all like real estate investment money that we pulled. The net proceeds on that first condo, even after doing the cash out refi and maxing out the amount we got out, was still over $91,000 that went into the 1031 exchange. And that 1031 exchange allowed us to not have to pay taxes on any of those proceeds and roll them in to a oceanfront beach house that is 4 bedrooms, 3 bathrooms in a community of 10 homes that shares a pool. And its average monthly rental income is $10,500. So we went from making $1,750 a month in a condo to making $10,500 a month in a beach house that we can also personally enjoy with our family and our children and bring our friends, and staying up to 2 weeks there a year without having to have any kind of negative consequences on our tax deductions and depreciation on the home.
Yeah, I mean, I love that. I mean, it's almost like you got these beach houses not quite for free, because like you put down payments in when you bought the initial condos, but you got these beach houses for what nets out to be a very small investment.
Yeah, over a period of 6 years, with maybe $45,000 to $70,000 of cash out of pocket, we were able to then turn that into $1 million beach house.
Wow. So that's what. So each beach house was about $1 million.
Well, so that first one we bought that was before the 1031, that was like another $185,000 condo. We were in that condo mode, and then in 21 we've got our first oceanfront beach house. And then again in 2022, we had a similar situation. We had single family homes in the Chattanooga area where, in this case, it wasn't that necessarily appreciation and rents didn't keep up. The city actually changed their ordinances. So we were going to be doing short-term rentals in the Chattanooga area. And so we bought these homes off market that needed work. We did the renovations, and then the city changed the laws on us and made it so we couldn't get a permit to short-term rental. So all of our plans, investment choices, the design choices, they wouldn't make sense necessarily to be long-term rentals. Like one house had a pool, and it's just like, that's a headache for long-term rentals, and numbers don't cover the maintenance on that. And so we were able to talk to our CPA and say, hey, we are not flippers. Like, we do long-term buy and hold. However, we've only owned these homes for less than 6 months because they've just been under construction and renovation this time. Is it okay for us to still leverage the 1031 exchange, which is designed for long-term investments? And he said, yes, you've got a history of long-term investing. You have a clear kind of external force that changed the game on you. And so he's like, I can totally stand behind justifying using the 1031 in this case. So then we were able to sell these other homes that were going to be short-term rentals. And we took 2 of those, and we had amazing forced appreciation and benefited from like a 20% annual market appreciation in the Chattanooga market back between 2020 and 2022. And then rolled those proceeds of roughly another $200,000 and bought another oceanfront beach house 2 doors down from that first one that we had got. And it was just kind of perfect timing. Those people who were selling it had been owners for a long time. They were tired of managing short-term rentals and dealing with all that headache. And we already had all the systems in place. We have great cleaners and all the resources we need. And we knew the numbers exactly. So I bought $1 million beach house sight unseen. I did not even go inside of it because I knew exactly what it was going to be. We had a home inspection with just option to void only. And this was back when like rates just started spiking, kind of summer of 22. And we couldn't qualify for conventional loans anymore. We had too many mortgages. I had quit my job. Like normal banks are not going to lend us money anymore, even though we make great money. So we were having to go and look at DSCR mortgages. Well, the rates then were not what I was expecting. I hadn't done my due diligence. I just kind of was like, hey, we've got a place for this 1031 money. I know it's going to be good. So it almost spiked the deal. I actually had to call my agent and I'm like, hey, I really hate doing this, but like the numbers don't work. You got to withdraw our offer. They had already verbally agreed to it. He came back and their agent, he's like, yeah, I get it. Like rates are crazy right now. What would it take for the rate to work for you? We're like, well, what do you mean? He says, well, the sellers are willing to do seller financing for you. And everything was just like, oh my goodness, this is like the greatest thing that's ever happened. I was like, well, I was hoping for like a 6% interest rate. He's like, done. And so we kept the original negotiated purchase price of like just a little bit over $1 million and got a 6% 30-year amortization seller carried note for 3 years. So now we have 3 years to figure out what we want to do with that money. We'll make cash flow, it'll appreciate, and we don't need, 2 oceanfront beach houses for our personal use. So we'll probably plan on selling it within the next 3 years and do something else.
Yeah, that's the great thing with real estate. There's always a way to work a deal out. There's always a way to make things work. It's just about getting creative. And it sounds like you had a creative agent and a creative seller to help you get that done. Now, how do you manage that? So you live in Tennessee now. The beach house is out of town. How do you manage that from Tennessee?
Yeah, so it takes systems. And that's the great thing. I'm a huge proponent of leverage when it comes to systems, software, finances, and then people. And so it takes people to run a short-term rental. It is hospitality. And so we have great relationships with our cleaner there. We have great relationships with a couple handyman and plumbers. So whenever we go out, I'm bringing bottles of Chattanooga whiskey. I'm handing it to them and saying thank you, making sure I'm sending them Christmas gifts and things like that. And then we rely heavily on virtual professionals. So we have a team of people that live in the Philippines. They have excellent written and spoken English and high-speed internet, and they're able to do like our listing management. They're able to handle guest communication. I give them a virtual phone service. So they've got a local phone number so they can make calls to our service providers. Like the AC is always an issue at the beach houses, right? And so guests say, hey, I'm having an issue. They'll call the HVAC company. They'll coordinate between the guest and the HVAC company for that tech to go out there and do those repairs. So I can be kept aware of the issues going on, but I don't have to be interrupted on the weekends, on turnover days, which are Saturdays, and interrupting my weekend with my kids and my family to have a very active management role in these homes.
So say on your average month, how much time would you say you spend on one of the properties?
That's a great question. Maybe a couple hours.
Okay.
And that's because I like to know my numbers. So my wife and I, we do a regular check-in where I'm pulling the numbers from our virtual bookkeeper, getting those reports that he makes for us in QuickBooks. I'm plugging them into our personal analysis spreadsheet. So we're always aware of where are our investments at? What are they doing? What is that return on equity right now? And so that way we can make corrections before things go off the rails.
Yeah, that's smart. I mean, you got to watch the numbers. That's really the most important part. You got to make sure you're making money on it. So do you see yourself at some point, if this property appreciates, I mean, you bought it for $1 million, if it goes up to say 1.5 or $2 million, the cash flow that you're making on it may not be giving you a good enough return anymore. Do you think you're going to keep this going and maybe sell that property at some point and trade up to something better?
Absolutely. Yeah. We want to be good stewards of the resources we've been given. And so if we're sitting on, $1 million of equity and it's making like a 2% return, it would be silly to keep that. Like we'll trade it up to something else. And I'll happily pay the $10,000 a week to go vacation there if that's where our family chooses to stay.
Harley mentioned earlier that he uses virtual professionals to help him manage his rental properties. If that's something that you want to learn more about, Harley owns a company called Worker Gen X, where he connects real estate investors to virtual professionals. And I've got a link to his company's website on my website. You can find it at rentalincomepodcast.com/episode 428. I'd like to thank today's sponsor for making this episode possible. It's Chaley Ridge from Ridge Lending Group. Chaley is a nationwide lender, and she specializes in helping investors finance rental properties. She has a ton of different loan programs, and she can find something that will work for you in your situation. If you want to find out more, or if you want to set up a time to talk to Chaley personally, maybe have her look at a deal that you're looking at, you can track her down at ridgelendinggroup.com. That's RIDGE, lendinggroup.com, NMLS 42056. Thank you so much for checking out the podcast today. Make sure you hit that follow button. I put out a new interview every single Tuesday, and if you're following the show, you'll get notified as soon as they come out. My name is Dan Lane, and this has been the Rental Income Podcast.